Thank you, everyone, for joining us. These are uncertain times for many of us, especially for those who are impacted by the recent wave of mass layoffs. And it's totally understandable to feel anxious and worried about the future. Please understand that we are here to support you as you navigate through these challenging times. The four of us are all certified financial planner certificates and fiduciaries, and we have been working with professionals in the tech industry for years. And today we will be sharing strategic strategies and tips that can help you survive during this difficult time period and also set you up for long-term financial success. Before we move on to the main content, I am required to share our disclaimer with you. This content is for general information only and is not intended to provide specific advice or recommendations for any individual. To determine what is appropriate for you, consult a qualified professional financial advisor. As you can see, there are four of us, so let us introduce ourselves one by one, and then we'll move on to the agenda page. Bill, you could go first.
Okay, thanks, MK. Hi, everyone. I'm Bill Can. I'm the founder of Can Capital. It's an independent wealth management practice based in San Francisco. And what I do is I provide, project consulting services and ongoing financial planning and investment management for clients. Aside from being a CFP professional, I'm also a CFA charter holder, which came in handy in my previous life as an investment analyst on Wall Street. And with that, I'll hand it over to Danica.
Thank you. My name is Danica Waddell. I am the president and founder of Xena Financial Planning. We do ongoing financial planning with optional investment management and work with people in the tech industry like everyone here, primarily women in the tech industry. Jeff.
Hello, everybody. My name is Jeff. I'm the founder of Brands Financial Planning. And like it says there, I do ongoing financial planning and investment management. And pass it on over to MK.
Okay, great. And I'm MK Lee. I am the founder of SimFi, and my financial planning practice focuses on education and coaching. And I also provide group financial planning programs. Okay, so this is today's agenda. Each of us will spend a few minutes going over four main topics: cash flow management, unemployment benefits, employee benefits, and stock compensation. And then at the very end, we will be taking your questions together. We'll start off with the cash flow management. So when faced with a layoff, it's important to have a plan in place for your cash flows. And these are some of the steps you could be taking. The very first step is understanding what your available sources of income is post layoff. So it will be essential to understand what your severance package details are. For example, how many months of full pay would you be receiving? And as for health insurance coverage, would there be additional coverage? And if so, for how long? Also, would there be any accelerated vesting for your restricted stock units? So understanding whatever income you could be expecting from your severance package, along with other income sources, such as unemployment benefits, or if you are a dual income family, your partner's income, understanding that would be your very first step. Then you would want to know what your big spending items are and have a plan around it. So going back to a healthcare topic, maybe you will be looking into COBRA benefits, or you may want to look into marketplace options, or maybe there's a chance to sign up for your partner's group health insurance coverage. Depending on which option you go with, the cost and the coverage details would be different. Once that's discussed, you would also want to be able to review your spending closely and set priorities in advance so you can minimize non-essential expenses. Dining out could be an example. If you're used to dining out frequently, maybe consider dining out less frequently, or maybe you're open to pausing on dining out temporarily until you know what your next opportunity or your next steps are. Also, this is a time to look at your emergency fund. Emergency fund is something we set aside in case there are unexpected spending or income losses. Some call it the rainy day fund, and the amount is usually somewhere between 3 to 6 months worth of living expenses. And as a financial planner, discussing how much emergency fund is needed and how to fund it will be one of the very first topics I'll be discussing with a new client. And it will be at times like this when you should be using it. Now, when your next job opportunity presents itself and you are back to receiving that stable income again, that's when you would want to fund your emergency fund again in case there are other rainy day situation in the future. It might be obvious, but I think it's still worth emphasizing that depending on how tight you manage your spending, you may actually have much longer leeway while looking for that ideal career opportunity. And for those who never budgeted before, this can be your chance to start budgeting and build that foundation that serves you now and also become the framework for your future budget during higher income years. So what I've mentioned so far would be all part of a plan A scenario where your post-layoff income sources and your emergency fund can support your spending needs until you find your next job opportunity. However, there could be situations where you may need to look into a plan B or plan C. And those situations arise when you feel like it actually may take much longer to make the career move that you want. And in those situations, you may need to withdraw from your savings. You may need to withdraw from your taxable investment account, which are your non-retirement investment account. And if you do need to sell out of those accounts, there could be tax consequences. But you might need to do that to support your additional spending needs. Also, this is a time to look at your health savings account. Health savings account, if you have one in place. Health savings account is something I would consider saving and investing for clients' retirement years. However, at times like this, depending on your cash flow situation, it might make sense to use it for your current medical spending needs. And also, depending on your situation, maybe taking temporary work or side gig could be helpful as well. Lastly, if you are a homeowner, house hack could be an option worth considering. And house hack here means renting out a room or more to help cover for some of your housing costs. And if you are renting, perhaps it could be helpful to look at more affordable housing options. There are some other ideas out there, such as utilizing a home equity line of credit or withdrawing from Roth IRAs. But there are potential concerns or things you need to keep in mind when looking into these options. So if this is the route you would want to take, then I would suggest researching carefully and discussing it with a professional. Next up is unemployment benefits.
Cool. All right, unemployment insurance. So like it says at the top there, unemployment insurance is a state-ran program. So every state is going to be a little bit different. I'm going to focus on California today, just as an example, but just be aware that it could be a little bit different depending on what state you're in. And first thing I would do is, if you are a California resident or a resident of another state, they probably have like an unemployment insurance booklet or kind of like handout. And that link right there that goes to the California EDD 2320, that's kind of like the EDD, ins and outs. I almost call it like the unemployment insurance Bible. Everything's going to be in there that you need to know in terms of how unemployment insurance works and how everything works at EDD, since EDD actually has a few different programs when it comes to paid family leave, disability insurance, and unemployment insurance. So I would do that first. I would go get a download of that document. Eligibility for unemployment insurance, very basic, laid off through no fault of your own. So generally speaking, that's either laid off or your hours are reduced. So when it comes to the reason that you're laid off, when you're speaking with unemployment insurance, you don't want to tell them that you quit, you were fired, or you're retired. That generally doesn't make you eligible for unemployment insurance because that's not through no fault of your own. If you quit, fired, or retired, you typically did something that was either in your control or wasn't good, essentially. And you do need to be available for work, looking for work, and willing to accept work. That's what they expect you to do. Unemployment insurance, it's tax that your employer pays into, and you essentially are being paid by the state to look for work. That's what they're paying you to do. So just have that mindset kind of, in your mind when you're going through this whole process. And it is a two-step process. The first one is the application. So you're just going to fill this out one time. And like I said before, when you're filling out that application, reason you are no longer working, just write laid off. Just keep it nice and simple. The more simple that you can keep your application, the better it is for unemployment insurance, and the better that they're going to expedite your application. You don't want to make things really confusing, like, yeah, I was laid off and, I really hated my boss and, all that. That's great, but they don't really care about that. They just want to know why you're no longer working. Just write it laid off. Keep it nice and simple. And then you have a continued claim form. This is kind of like your time card for unemployment insurance. Like I said before, you do need to be available, looking, and willing to accept work. And they want to know that on a week-by-week basis. So you need to tell them on a week-by-week basis that you are available, willing, and looking for work. And you're going to do that on your continued claim form. You got to fill that out once every 2 weeks. If you don't fill it out, you will not get paid. So definitely have to fill that one out if you want your unemployment insurance benefit. The claim window. So your window of actually when you're eligible for benefits is 52 weeks. That's the full claim window. Now, the max benefit you can get in that window on a standard claim in California is $11,700. Now, if you get the max benefit per week, which is $450 per week, you'll max out your benefits in just 26 weeks. The reason they give you a 52-week claim window is because there are going to be some weeks where you're on vacation, or maybe you took a consulting project for 2 weeks. If these are circumstances that fall under your umbrella there, you won't get paid for those weeks. You could get a partial benefit if you only missed 1 day, or if through your consulting gig you only made a certain amount of dollars. I'm not going to get into those details, but if you made a certain amount of dollars, you could potentially only get like $100 or $200. That is possible, but that is generally how that works. 52-week is your claim window. The most you can get is $11,700. UI benefits are not retroactive, so you can't wait 15 weeks and then say, okay, I'm ready to file, and they'll give you back pay. They don't do any kind of back pay like that. So once you're eligible, definitely apply immediately. Federally, these are taxed. You can have up to 10% withheld on each paycheck, but no state taxes. Couple things as well. Severance. Most of you are getting severance. You want to report that one time on your application, and you want to report the lump sum. So some of you are getting like your biweekly pay for the next 6 months. Take that gross lump sum amount and report it one time on the application. Do not report it on a continued claim form. That is just going to confuse the people at EDD, because severance doesn't count against your unemployment insurance benefits. You technically already earned that money at your previous company. Same thing with PTO pay. Same thing with sick pay or anything like that. If they're giving you all that money, that's great. It's not going to affect your unemployment insurance. You just need to report it though on your application, because anything that you report on your application, EDD is going to call your previous employer and they're going to verify everything with them. So you need to make sure all your facts kind of line up. Let's see, war notification. So if you're going through a war notification where they're giving you essentially a 60-day window, that's kind of a gray area. I think that you can open up your 52-week claim window during this period. Whether or not you're actually going to get paid, I've heard kind of mixed stories on. So if you're not going into the office anymore, I think that you should be able to start your unemployment insurance claim. But you can at least apply. They won't exactly deny you, but what they potentially will do is just say you can't get paid for the next 60 days while you're going through your WARN notification. And that's okay. At least you have the claim open and you'll get paid essentially right when that is over. All right. Also on the claim form, I'm sorry, time here. On the claim form, you have to report, it asks you to report where you actually look for work. You don't have to fill that out. Nobody at EDD reads that. You could just, if you get audited by EDD and they ask you, what have you been doing to look for work? You definitely want to have some kind of backup in terms of what you've been doing to look for work, such as anything and everything. Talking to previous colleagues, that's looking for work. Like it says up there, you have to be available, looking, willing to accept work. It's not just sending out applications. It's anything and everything when it comes to you kind of looking for work. So just have that kind of mindset in your mind, talking to previous colleagues, going to, workshops like this is potentially, looking for work and whatnot. And you will potentially get randomly audited, like less than 5% get randomly audited. And that's okay if you do. They just want to make sure that you're kind of telling the truth. Also, last part, California training benefits. This is big. Each state has their own little program on how they do these things. But California training benefits are essentially your tax dollars hard at work. You can go into workforce centers and they have programs where that will pay for training programs for you. They will actually pay for it for you, several $1,000s. And B, you can get your unemployment insurance claim extended. You can earn up to double. So and the best part, you don't have to be available, looking, and willing to accept work while you're going through the training program. So you continue to collect your unemployment money, they pay for the training program for you, and you don't have to look for work if you feel like this is right for you. And a good example I always use is like a PMP for project management. That's a big certification to get if you're in project management. I've heard lots of different stories about folks going through a workforce center through EDD. They pay for the program for you, and you get to continue to collect your unemployment insurance. So something you want to check out. And that was all I got for you. I'll pass it on to, I think, Bill. Yes, Bill.
Yep. Thanks, Jeff. So thanks, MK and Jeff, for the great overviews of cash management and unemployment insurance. I actually followed a very similar game plan to what MK and Jeff laid out when I was laid off in 2009. And that was during the great financial crisis. And, to no surprise, stress and anxiety levels were high, and getting a handle on cash and unemployment benefits helped a lot. And it allowed me to prepare for the next chapter of my career. So my segment is employee benefits. There's a lot to cover, so I'm going to get started. First, I can't stress enough the importance of getting organized when it comes to benefits. This is a job that you definitely want to use a checklist because there's a lot that you want to gather. Be it paper or electronic, it doesn't matter. Get a checklist to help you because you want to gather the descriptions of your various benefit programs, have receipts and data of relevant transactions relating to, say, your healthcare spending, insurance, 401k statements, and so on. And definitely don't wait to get started. Even start now before, if you haven't done it already. It may not be so easy to gather the information after you leave your job. So I do stress, get started now. The next thing I would do is to review everything and prioritize the benefits. Like many people, my priorities were healthcare coverage and my 401k. For healthcare, the two big questions to ask are, what healthcare coverage do I need? What level of coverage do I need and want? And where do I get the coverage? So keeping your current coverage is definitely possible under COBRA, right? And to me, it was about continuity of care of sorts, but it comes at a price. The cost would likely go up more than double without the employer subsidy. Other choices include the marketplace. In California, it's known as Covered California, or maybe enrolling in your spouse's plan. What happens is that upon leaving, you enter a special enrollment period. If you intend to use COBRA or the marketplace, you have 60 days to sign up. So don't miss that deadline. If you want to go on to your spouse's plan, which in some places include a qualified domestic partner, the deadline is 30 days. Okay, so please be aware of that. COBRA usually lasts for 18 months, but there may be state-specific COBRA rules that may be actually in your favor. So do some homework and check that out. Healthcare-wise, don't forget your savings account that are related to healthcare. They can really help you get over the hump of being laid off, as MK mentioned earlier. So for example, if we have a flexible spending account, an FSA, that's the one where it's like you use or you lose. Now is the time to use it up. If in case you don't know, you have access at the beginning of the year to all the money that you said you would contribute over the entire year. So at the beginning of the year, if you said, I'm going to max out, you could have as much as $3,050. So what you want to do is have the receipts handy, receipts for qualified healthcare expenses, submit your claims, don't wait. And if you're going to do it after you leave your job, be sure that you've spoken to your plan administrator to know the rules and the length of time you have to submit the claims. So don't waste it. As NK mentioned, your health savings account could be a great resource in these times. It's a source of tax-free money, right? If you need the cash, or as MK said, a great way to save. Once again, keep your healthcare receipts, because that's how you're going to say, if I take a withdrawal, it's related to a healthcare expense. It could be in the future or it could be in the past, but if you have the receipts to document it, you can pull the money out tax-free. Okay, so let's move over to 401k plans. Two big questions to ask that immediately come to mind is my 401k and other investments in my portfolio properly aligned with my goals and my circumstances, which, as you know, may have just changed, right? Second question is, should I roll my retirement savings out of my employer's 401k plan into an IRA or another employer's 401k plan, right, when you land a new job? Just know that it is perfectly okay to leave it where it is if it makes sense. Most employers allow you to leave it there, but in some cases they may not. If they do allow it, there's no deadline, so no need to rush. But as you think about this, what things I would ask is, what are the costs to stay in my current plan? What are the investment options? And what is the performance of those options, right? Those were some considerations, and others too that would help me think about, should I stay or should I roll it over? Now, next thing is about insurance. Other than healthcare, many of us have health and disability insurance through our employers. The big question here is the coverage portable? Portability means that you get to keep the coverage after you leave. Now, having insurance coverage is important. Life insurance can protect your loved ones in case of death. Disability protects income in case you cannot work due to a disability, which actually affects 1 in 4 people before retirement. So it is important. Now, they're important, but they could be costly. So check the premiums that you would have to pay to continue the coverage and gauge how it fits into your budget. Okay, and to close my segment, I want to leave you some thoughts about gym memberships or access to museums and other things that you might get from your work. Some of these things could be really important to some of you. Access usually ends when one leaves their job, but it does not hurt to ask. You may be pleasantly surprised that the employer may be willing to extend it. One benefit that I found to have great value was access to career counseling services that was part of my severance package, right? This is, back in 2009. Why it was important was that it helped me prepare my transition from being a research analyst on Wall Street to become a financial planner and invest and do investment management for people. Now, let me pass the mic to Danica to talk about stock compensation.
Thanks, Bill. So stock compensation could be a little bit lower on your list of priorities. I mean, number one, of course, is going to be things like, can I pay my mortgage? But stock compensation has some important things that you definitely want to keep in mind, in particular, some that are time sensitive. So when you are let go or laid off, one thing to keep in mind is that anything that has not vested, you have now lost. So we're talking about anything that's vested as of your last day. And this is a good opportunity to mention that this is the sort of thing that's actually negotiable. I had a client that I was working with in the fall who was laid off from her employer, and it was something like 2 days before her first vest date. And so she went back to the employer and said, can we negotiate my end date to be, October 1st instead of September 28th? And then I have actual access to some of my equity. So that is one thing among others. There are definitely some other things that are negotiable, but that's one thing to keep in mind. Anything that has not vested though, as of your final date of employment, you no longer have access to. So the first thing that I would do in a situation like this is gather as much information as you possibly can. So if you have access to the stock plan agreement, make sure that you have a copy of that. If you don't, try to get one as soon as you can from HR. You also want to have the details of any grants that you have been given and the vesting schedule for those. So it's most important to just understand what it is that you have, and then you can decide whether or not there's any action that you need to take. So gathering all your documents, making sure you have access to as much as possible. You may or may not have access to different portals for a certain amount of time. So whether it's Carta or ShareWorks, you just want to make sure that you have copies of everything that you can. The next big question is, I think when you're looking at whether you work for a private or public company, is do you need access to any of the, do you need the cash basically? So MK did a great job talking about just sort of, evaluating where you might pull money from. So that can be an emergency reserve, that can be taxable investment accounts, but your company stock is a great example. If there's some, if there are ongoing needs that exceed your emergency reserve, or if there's something significant that's coming up that you need cash for, you may need to actually sell some company stock. So that's going to be a really big question to ask yourself is, do I need to make a decision about this right now, or is that something I can delay? If you work for a public company, it's going to be a lot easier because you can actually sell your company stock. If you work for a private company, your options are much more limited. But there are companies that do sort of secondary market sales and financing. So depending on what type of equity you have and all of that, there might be some option to do a sale on a secondary market. But for the most part, if you work for a public company, pretty straightforward. Private company, it's going to be much harder to actually access any of the funds that you have in your equity. So here's a time-sensitive piece of this. Incentive stock options are the most critical to have a plan for because they do actually expire 90 days after your termination date. So this is a federal law. There is no way to get around this. If you have incentive stock options, you must exercise them within that 90-day window or they will expire. Now, I want to talk a little bit about expiring because there's a couple different options. In some cases, the incentive stock options will convert into non-qualified stock options. So you might still have stock options, they'll just be a different type. And in other cases, they will expire completely and you won't have anything. So you just really want to be clear about which scenario you're operating under because it's extremely time sensitive and there's really no negotiating on this one. The other thing is if you are going to do something about your stock options, say you decide, yes, you want to exercise or you want to pursue some kind of, financing deal with a private secondary market company like Equity B or something like that, you want to get started as quickly as possible. You don't want to wait until day 88 to say, oh, I think I want to do this. It can take a while to get all this stuff in place. So with the incentive stock options, time is really of the essence and you want to start that process as quickly as possible. I already talked about vesting stopping as of your date of termination. The considerations, like I said, whether or not you actually need cash is a huge piece of it. The other thing that I think is worth assessing for your situation is concentration risk. So what concentration risk is basically, how much of your portfolio is tied up in your company stock. So if you work for Meta and you have a whole bunch of Meta RSUs, you might have a lot of your overall portfolio allocated to Meta stock. And so that's a concentration risk, frankly, whether or not you're you're employed at Meta. But it is something that you want to evaluate when you're laid off and just sort of say, okay, I've really had all of my eggs in one basket here. If they're doing layoffs, that may or may not be a good sign for their, the company's future prospects. So it could be a really good time to have a strategy for divesting out of your company stock. And that's something that really makes a lot of sense to work with a professional on. There's tax implications and all that sort of stuff for selling out of your company stock. But I think it's it's just really important to, sort of take that step back and evaluate where you are with regards to concentration risk. Working with a professional always, but I think with equity, anytime you're exercising incentive stock options, you want to be extra careful about things like AMT and any other tax implications of what you're doing. So it's really easy to make a mistake here and end up with a surprise tax bill. So if you're doing anything around your equity, I absolutely encourage working with a professional and making sure you're really clear on the tax bill. The last thing you want to do is, generate some kind of tax bill when your cash is already really tight. So just be really, really careful around any decisions that you make in this arena. So this is a very, very high level overview on equity comp. Incentive stock options are really the only thing that's time sensitive. If you have other types of options, or if you have RSUs, you have however much time you want to take to make a decision about whether or not to do something differently with those. But there's a lot of complexity here that we're really just scratching the surface. So I think that's all I have to say.
Great. Thank you, guys. So our presentation session is over, and we're ready to take any questions you guys might have for us. And I realized I did not mention this at the very beginning, but this whole session is being recorded and will be available afterwards in case you are wondering. So any questions you guys might have, please type in the Q&A box, and we'll go over them one by one with you. And while we're waiting, I thought maybe we could ask ourselves a question. So we talked about a lot of things that can be helpful. Now, if someone were to ask us, which will be the most time sensitive matter to consider? What do you guys think?
I'd say health insurance.
Yeah.
That one's usually pretty top of mind, especially if you have any kind of ongoing health needs. If you're, chronic conditions in your household, or if you have a whole family relying on the healthcare benefits, that would probably be my number one.
Yeah.
I would say health insurance and cash. And, yeah, those would be highlights for me.
Totally. I agree. Understanding where our spending is going, and health insurance is one of the biggest items. So much more if we're considering COBRA benefits. So totally. Okay, we have a question. So during the while we were going over the stock compensation details, Danica mentioned that incentive stock options will expire 90 days after termination date. And the question is, in case of non-qualified stock options, do they usually expire after 90 days as well?
I don't feel compelled to answer this one unless you want me to. Anybody else want to take it?
I think it could be a short answer. I could take a crack at it first, which is yes, and I think it depends on the documentation. So understanding the stock plan agreement, understanding what it entails upon termination would spell out what the full details are. And there can be longer time periods, but I think what we usually see is usually 90 days. What do you guys think?
Pretty common, 90 days.
I think the difference here is there's no federal requirement for them to expire after 90 days, the way that there is for incentive stock options. But yeah, I think that's definitely a common time frame. But like MK said, referring to the stock plan agreement is definitely the most important thing.
And that's another thing you could negotiate when you're going through this.
True.
I
Yeah.
guess one thing I would add, if you're going to negotiate anything, get it in writing.
Always.
get it in writing.
Mhm. Also, I feel like we didn't touch on any like smart tax planning topics while we were going over the ideas to consider. And maybe we could touch on that for a little bit. Like, what are some ideas can people think about in case they are in a low tax income years? If in this, how can we make lemonade out of lemon? I think that would be the gist of that question.
I mean, I'll chime in on that one. I mean, two things. One is, let's say you lose your job now, early in the year, you think you're in a low tax year. Well, I would say stop and pause and understand your severance package, because it may not be as low as you think. So be careful of that. Second of all, with your 401k situation, for example, maybe it's time you can consider, if you didn't have the ability to convert before convert it to a Roth IRA, if it makes sense, especially in a low income year. So that would be one situation where that would definitely come in handy if that was the case.
Yeah.
Or if you're going through a warn notification, if you're still an employee for the next 60 days, if you get laid off right now, we're only a quarter of the way through the year. So if you are still on payroll and still making 401k contributions, maybe switching them to Roth if you're doing pre-tax before, or maybe even maxing it out between now. If you're going through, so a warn notification is like a federal law. Basically, you have to be on the payroll, or you have to be, an employee for 60 days following when you get your layoff notification. It only happens to if you're, I think, more than 50 people at a company get laid off within a 30-day period. I believe it's 30 days. They essentially, have to pay you for the next 60 days. Sometimes they'll keep you on the payroll for the full 60 days and have you work out the entire time. Sometimes they'll just send you home. And if they do keep you on the payroll and you're working, but you're going to be gone in 60 days, maybe you could increase your 401k contributions because you don't know when you're going to get a job next. And you could potentially max out your 401k between now and the end of the 60 days.
Yeah.
I would just add, with any kind of tax planning, particularly like a Roth conversion or something like that, I would wait till the end of the tax year. There's really no need to do it in July. If you get laid off in July, I would wait until November, or maybe even December. You don't know if you're going to get a new job or a signing bonus or something later in the year. So I'd be pretty careful about doing anything like that until relatively late in the year. I mean, the exception to that is going to be incentive stock options, because you don't have a whole lot of time. But anything like a Roth conversion or anything like that, I would definitely wait as long as you can in the calendar year.
Mm-hmm. Totally agree. And I think so, there could be Roth conversion opportunities, switching how you contribute to your 401k while you're still in the job could be another idea. And also maybe if there is certain highly appreciated stock positions, maybe it could be a year to realize some of those gains. And I think to Danika's point, timing it at the very end of the year, where you have a better idea of the overall tax picture, would be a much better time to consider all of these together. And definitely working with a tax professional would be really important. We have another question regarding COBRA benefits that, can we elaborate a little bit more about it? Can it be retroactively done? It's definitely more expensive, how it works.
Sure. So, COBRA kicks in after your coverage as you have it now when that terminates, right? And you have to elect it. So you have basically 60 days to decide. Okay. And it is expensive because, let's say if you're used to paying X dollars, well, a lot of times the employer subsidizes it, and the subsidy could be matching what you pay in. So without that subsidy, it could double, it could be even higher. So that's a surprise for a lot of people. And let's say you are working in a company with a great health plan, right? And you don't use most of the services, which you just don't need to. Well, that could be like a soup, you would view that as a very expensive thing now. And because of the situation, you are in a special enrollment period. So potentially, if your company has multiple off-plan health plan offerings, you can actually potentially decide to change to a lower cost one if you want. And if that wasn't the case, you can go to the marketplace and shop around and to find options that are less expensive. And once again, you are in a special enrollment period because usually enrollment for the marketplace is towards the end of the year. But because let's say you just got laid off today, they'll let you enroll for 60 days, right? To select a plan. So it's worth shopping around and doing all that. So yeah, all these things could, if you've been fortunate to have a great plan, things could be at a low cost, things have changed quickly. And unfortunately, that's just the state of our healthcare situation. But know and shop, well, compare your options. And there are chances for you to make adjustments because you are in a special enrollment period.
Thanks, Bill. Yeah.
I'll just add on to that. I mean, not only can you adjust your plan, but you can also very easily say, I don't need to keep dental. Dental's not essential, but I'm going to keep my health insurance. So even if you're enrolled in, dental and vision, you don't have to sort of opt in for all of those things. But you do have 60 days to make a decision. So you can wait, if your last day is October 31st, you don't have to decide about COBRA until December 31st, and it can be retroactive. So if you decide as of December 31st, yeah, I want to keep it, it will go back to your final day.
Great. Thank you. Any other questions before we wrap up today's session?
Oh, I'm gonna go back to a previous question.
Yep, let's go for it.
Tax smart things. Let's say you happen to be a person that own company stock in your 401k. Okay. There's a rule regarding net unrealized appreciation, which is kind of not widely discussed, right? But if you have highly appreciated shares of your company stock that you hold in your 401k, I would say take a pause. Don't make any rash decisions as to, I should roll it or not roll it. Because with good tax planning, you can potentially save a lot of taxes on those shares. And so so potentially you would take an early withdrawal, pay the tax on that, but then, if you have shares that you bought at a very low cost basis, right, you may be able to get that tax as capital gain, long-term capital gains, as opposed to the money coming out of, say, your retirement plan, right? That gets taxed as ordinary income, which for many people is much higher than capital gains. But once again, this is one where you definitely want to talk to a professional to help guide you through it, because there's a lot of moving parts. But if you're in a situation where you have highly appreciated shares, then great, and think carefully about it before taking action.
Great. Awesome. I think we took all the questions today. So thank you everyone for joining us today. We hope that the strategies that we shared with you can help you navigate through these uncertain times with more clarity and confidence. And please know that we're here to support you. So if you have any other questions, just let us know. And all 4 of us are taking new clients. So if you have any if you need any help with any personalized guidance, feel free to reach out to any one of us. Thank you.